Hey everyone, in this video I'm going to bring you one growth stock that's down 72% off the high that I think you might regret not buying on the dip heading into 2024. In this video I'll share with you what I like about this growth stock. I'm going to share with you some of the risks that I see with this growth stock and why the stock is down so much, and finally bring it all together to suggest why I think this makes a good investment for 2024 and behind. Frankly, you can hold it beyond 2024, not just for 1 year. So let's get right into it. Let's see the details of this investment and what's the name of this growth stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the growth stock that I'm talking about is DigitalOcean. It's down 72% off its long-term high. Even though it's bounced back off the low, it's still down significantly off the high. So let me share with you what's going on with DigitalOcean. So here I have its latest quarterly financial highlights and key performance indicators. There's a few things I'm going to highlight that's working well for the company. One thing notably that's not working well, and that's most likely the reason the stock price is down in this off its significant high. So you look at revenue, the company has demonstrated nice revenue growth throughout, from growing from 111 million in the third quarter of 2021 all the way up to 177 million in the third quarter of 2023. What you'll notice is that the growth rate was much higher, 36% in 2021 and 2022. And it started to dip from 37 to 36 to 30 to 27 and down all the way to 16% growth in the third quarter of 2023. The bulk of that decrease in growth rate is not because the company's not attracting new customers, because they are attracting new customers, but the problem has been with existing customers. So let me highlight that. So down here, the net dollar retention rate. This measures how much existing customers spend with you year over year. So if the customer spends the same amount of money in 2023 as that customer did in 2022, this net dollar retention rate would be 100% because they didn't increase or decrease their spending. They kept it the same. So if it's over 100, that means existing customers are spending more than they did the prior year. And so for the most part, that was the case, right? 116%, 116, 117, 118, 112, and then 107, 104, and now 96. So now the company is experiencing existing customers being a drag on its revenue growth. Management noted that they're likely going to exit 2023, meaning in the fourth quarter, again in the 90s. So they're going to be decreasing. Existing customers are spending less than they were the prior year. Now, this is for a number of reasons, but it's troubling nevertheless, right? Starting in the fourth quarter of 2022 was when really the decrease in spending started from enterprises. That was when, remember, the central bank in the US and around the world really started ratcheting up the interest rate increases. And that started to bring fears of an oncoming recession. And so enterprises started to find areas and look for areas where they could cut spending. So one place to cut spending was with DigitalOcean, and they found areas to optimize their cloud spending and decrease wherever they could, and DigitalOcean has been a casualty of that. Although it's not severe, right? 96% just means that this year's customers are spending 4% less than they were in the same year last year, right? But typically what you notice with businesses like DigitalOcean is customers increase their spending with you as they get comfortable with your software and your service. As the business grows, the average revenue increases, but that hasn't been the case for DigitalOcean. Still, the average revenue per customer has increased, right? Meaning they're attracting the newer customers they're attracting are spending more, and existing customers are growing and scaling. And as they grow, they spend more, and that's been working for them. But this net dollar retention rate, that's a risk, and that's one reason why the stock price is down so much, in addition to the lower growth rate. But the lower revenue growth rate is mostly due to the lower net dollar retention rate. If the existing customers were to spend more, if this was to be 105% instead of 96%, then the growth rate would be much higher as well. So this is the thing that's dragging down the growth rate for DigitalOcean. Still, when you look at the company a little bit longer term, even though the growth rate has slowed, the company is now solidly generating strong cash flow from operations, 217 million in cash flow from operations in the trailing 12-month period. So even though growth might be slowing down, their cash flow from operations are going up as they've gotten better at operating the business, as they're starting to reap the benefits of the investments they made a few years ago. You can see CapEx as a percentage of revenue has also decreased, right? From 24% all the way down to 12%. As you know, when you're running a software company, a services company, most of that investment is upfront, and then you get to reap the benefits of those investments later on down the line. And that's what's happening with DigitalOcean. And I suspect there's just an organic growth coming to DigitalOcean because they serve mostly small businesses, right? They could go to AWS for their cloud needs, but AWS is just so much more complicated, so much more complex. You need more technical knowledge to implement AWS, whereas DigitalOcean makes it easier for small businesses that don't have that much technical expertise to go online and really become a digital business. And just every year, that digital transformation is going to organically bring customers into the industry where DigitalOcean will benefit. And the company has started to turn things around on profitability as well. DigitalOcean, like I mentioned, was one of those businesses that, anticipating an economic slowdown, they cut costs, right? DigitalOcean laid off several, a good percentage of its workforce in February, and they implemented lower cost areas. They mentioned they're going international, opening offices or getting labor internationally versus domestically. That's lowering costs for them as they're able to operate in that way. And so they've improved their operating profitability. You can see from negative 30 million at the worst trailing 12-month period all the way up to positive 10.41 million in the latest trailing 12-month period. So they adjusted with the changing market dynamic to make themselves operate effectively regardless of the environment, even though the environment slowed down. So I give management credit for that, and I'm always more willing to invest in companies that demonstrate prudent management versus the opposite. And then finally, the last reason why I think this is an excellent growth stock to buy that you might regret not doing so, is the cheap valuation, the relatively cheap valuation. DigitalOcean is selling at a forward price to earnings of 22.63, which for a company that's growing its cash flow and growing its profitability and growing its revenue at the rate at which it's growing, and it's addressing its total addressable market opportunity is expected to grow to over $100 billion. All of that suggests that the valuation could be higher, and this valuation is relatively cheap. So for all those reasons, I think DigitalOcean is one growth stock that's down meaningfully off its high that I think investors can buy for 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.